All right, so the S&P 500 just closed at 6,870.4, and that's up 0.19%.
Right. A gain, but a pretty quiet one.
It is. I mean, this is the ninth positive session in the last 10, and we're sitting right near 52-week highs, but it just feels, I don't know, almost anticlimactic.
I think that's the perfect word for it. And today was fundamentally all about positioning, just repositioning.
So let's unpack this, because under the surface, the market is sending some really, really contradictory signals.
It absolutely is. I think you nailed the theme right there. Investors are just setting up shop for next week's big FOMC meeting.
And they got a huge piece of data for that today.
A huge piece of confirming data, yeah. The release of the delayed September core PCE inflation figures. And, well, the market absorbed it in probably the most complex way it could have.
That delayed data was definitely the headline catalyst, and it was unambiguously benign.
Totally benign.
We saw the core PCE come in at 2.8% annually. That's a tenth of a percentage point dip from the prior month's 2.9%. It continues that moderate trend the Fed really needs to see.
And that tiny little dip, that 1/10 of a point, it mattered. It mattered immensely for near-term sentiment. If you look at the market-based probability for a December rate cut.
A 25 basis point cut.
Exactly. That probability now stands firmly at, what, approximately 87%. The market is basically shouting, the path of least resistance here is a cut. The conviction is just, it's very high.
Okay, so here's where we run straight into the paradox of the day. This is the thing we really need to explain for you.
The big contradiction.
The big one. Large cap equities, like the S&P 500, they rallied. They're celebrating that potential rate cut. But at the same time, longer-term Treasury yields rose and small cap stocks declined.
It makes no sense on the surface.
None. The market is cheering for easing while simultaneously pricing in higher rates down the road. It feels less like conviction and more like a market stuck in a really high-tension, complex transition.
Exactly. I mean, the textbook narrative should be simple, right? Benign inflation, easier policy, that should send bond yields down and equity prices up across the board.
But it didn't.
It just didn't happen, especially in fixed income. The bond market is hedging against something, and we need to figure out what that something is.
Let's focus right in on that bond market reaction. Why on earth did Treasury yields rise if the inflation data was so good and supports easing?
It's the key question of the day.
The 10-year yield rose 3 basis points to 4.140%. The 30-year also went up 3 basis points to 4.790%. It's so counterintuitive. It means investors were actively selling their long-dated bonds.
They were shedding duration. For anyone not familiar, that just means selling the bonds that are most sensitive to interest rate changes.
Which is the core analytical challenge today. Why do that when a cut is 87% priced in?
Well, our analysis points to three sort of primary potential reasons for yields rising right into what looks like an imminent easing cycle.
Okay.
The first one, it really addresses the long-term forecast.
You mean the Fed's dot plot, the updated one?
Precisely. Investors might be front-running a potentially hawkish 2026 forecast in that new dot plot. Powell could, cut now, give the market that immediate relief it wants.
But the long-term picture could be different.
Exactly. The Fed's projections for 2026 could signal fewer future cuts than the market is currently pricing in. So if the market is expecting, say, 4 cuts next year and the Fed projects only 2, well, long-term yields have to adjust to that right now.
So that's the long-term caution just completely overriding the short-term good news from the PCE. That makes sense. But what's the second reason?
The second reason is more structural. It relates to something called the term premium.
The extra yield you demand for holding longer bonds.
Right. That premium is expanding, and it's because of underlying fiscal concerns. We're just seeing a massive increase in government debt issuance, and there's a real persistent doubt about the market's ability or even its willingness to absorb all that new supply without demanding higher yields.
A supply and demand issue, basically. So what's the simplest explanation of the three?
The third, and simplest, is that technical selling pressure just dominated the fundamentals today. With a huge event like the FOMC meeting next week, liquidity can get pretty thin.
And in a thin market.
In a thin market, technical selling flows can just overwhelm that dovish fundamental story, causing yields to spike. It could just be noise, honestly, but we can't ignore the possibility that the bond market is genuinely spooked by either that 2026 dot plot or just the sheer scale of the U.S. debt pile.
What's so fascinating is that even with this serious hesitation in the bond market, anxiety levels in the equity world are, well, they're remarkably low. The VIX, the market's fear gauge, it dropped to 15.41 today. That's down 2.34%.
Subdued anxiety is the perfect way to describe it. And to put 15.41 into context for you, that level suggests that expectations for volatility are pretty contained. The market is, by and large, priced for a pretty benign Goldilocks kind of outcome.
Right.
But that rising 10-year yield we just talked about,
Yeah.
that's the key point of tension. It suggests the path into and out of the FOMC meeting might not be so smooth for everybody.
And you can see that tension immediately when you look inside the equity market itself. Let's pivot there, because the divergence between the big stocks and the small ones was just so stark.
It really was.
While the S&P 500 advanced 0.19%, the Russell 2000, which represents those small-cap stocks, it declined 0.38% to 2,521.48.
That small cap underperformance is such a clear, tangible signal of risk aversion at the margins. The Russell 2000 traded, 0.57% worse than the S&P 500? That is a significant spread.
So investors are happy to buy the big liquid names.
The battle-tested ones, yeah. The ones that can better weather a potential Fed surprise or some economic uncertainty, but they're pulling back from that higher-risk, debt-sensitive small cap space right before the big policy decision.
And this cautious rotation, you can see it in the sector leadership too.
Absolutely. Communication services led all the sectors. It gained 1.16%. And in this kind of environment, comm services is often seen as a place for a sort of defensive rotation. It's not super cyclical, but it still captures some of those growth trends.
And on the other end.
On the flip side, healthcare lagged. It was down 0.42%.
And you can't really discuss communication services today without hitting on the major M&A news that just dominated the session. It complicated things even within that leading sector.
Oh, yeah, the massive news. Netflix.
Netflix declined approximately 3% after announcing a massive, and I do mean massive, $72 billion acquisition of Warner Bros., Discovery's film studio, and the HBO Max streaming service.
It is a monster headline. It's going to completely redefine the streaming landscape. They're paying $27.75 per share for WBD.
And the market reaction was pretty textbook.
Completely textbook. Netflix, the acquirer, falls about 3% on just the sheer scale of it and, the potential integration nightmare of absorbing a $72 billion asset and all its debt.
Meanwhile, the target, Warner Bros., Discovery.
They gained 6% on the merger news. Simple as that.
I mean, the regulatory hurdle alone for a deal this big has to be significant.
It is, and the analysis we saw noted that a senior administration official already expressed, quote, heavy skepticism about the deal. That suggests it's going to be an extremely long road through antitrust review.
So the deal is announced, but its completion is far from a sure thing.
Far from it, and that just adds another layer of complexity to that whole sector.
But beyond all the M&A and the sector rotation, some of the underlying growth trends, they just kept showing relentless strength, almost regardless of what people think the Fed is going to do.
Right.
I'm thinking specifically about that AI infrastructure theme, data centers.
That theme just will not quit. Digital Realty gained 2.30% and Equinix gained 2.13%. Whether the broader markets are consolidating or not, the build-out of AI infrastructure is still a key, persistent investment focus. It's drawing capital pretty consistently.
It's acting almost like a defensive growth play right now.
That's a great way to put it.
But even with the small caps looking weak, the overall market breadth, so the number of stocks actually participating in the rally, it was actually quite healthy.
It was strong. Yeah, surprisingly strong. The S&P 500 registered 31 new 52-week highs versus only 5 new lows. So this was not a rally isolated to just, 5 mega-cap tech stocks.
Right. We saw some big, diverse names on that list.
We did. Bank of America hit its highest level since December of 2006. And you saw all-time highs for names like Goldman Sachs, Caterpillar, and Walmart.
So that tells you that underlying economic strength is being validated across completely different sectors. Banking, industrials, retail, all hitting these huge peaks.
It's a much broader base of support than you might think just looking at the headline index number.
Okay, let's shift gears completely now and look at the commodity complex. It saw some incredibly dramatic moves today, and it really represents the ultimate breakdown in any kind of macro correlation.
It's almost comical how divergent these moves were.
Where do we even start?
I mean, we have to start with the most dramatic move of the entire session across all assets. The collapse in coffee.
Coffee plunged a massive 13.44% to $356.60. A one-day double-digit drop in a major commodity like that is
It's
highly unusual.
extremely. And it was driven by two things. First, Brazil tariff relief, which eases trade barriers.
Yeah.
And second, significantly improved weather forecasts for the crop.
So it triggered a huge liquidation.
A huge, sudden position liquidation by speculators who were all betting on supply constraints. They just got wiped out.
But at the exact same time that coffee was crashing on good weather news, Natural gas was surging on winter demand.
Exactly. Nat gas climbed 4.66% to three-year highs. It hit $5.30 per MMBtu.
And that's just pure demand fundamentals.
Pure demand. Seasonal winter demand, plus reported record LNG exports, which are up 40% annually in November. One sector is selling off on supply relief, the other is surging on demand strength. They are completely decoupled.
And you saw that same exact friction in base metals. Copper jumped 3.05% on China optimism.
But then aluminum collapsed 5.45% on China overcapacity concerns.
So you had an 8.5 percentage point spread between copper and aluminum in the same session,
Yeah.
driven by totally opposite views of the same macro region.
It just highlights how idiosyncratic these individual supply-demand dynamics are right now. They're trumping the broader macro factors. The correlation matrix is just completely scrambled.
Let's talk about one more extreme divergence. The equity crypto breakdown. We had the S&P ticking up, signaling some general risk appetite.
While digital assets were falling in unison.
Yeah. Bitcoin declined 3.11% over 24 hours to $89,425. It's testing that critical support level below 90K.
And Ethereum slid right along with it, down 3.32% to $3,029.57.
So what do you make of that divergence?
It suggests either there's some structural deleveraging going on in the crypto space, or maybe it's just a simple rotation out of digital risk assets back into traditional ones ahead of the Fed meeting.
A flight to perceived safety.
Maybe, but what's maybe even more important than the headline drop is the internal positioning within the crypto complex. Bitcoin dominance is extremely high. It's at 74.54%.
And that high dominance tells us what, exactly?
It indicates defensive positioning inside that ecosystem. When crypto investors get nervous, they sell the riskier, smaller altcoins. We saw Dogecoin drop 6.10% today, and they rotate that capital toward Bitcoin as the relative safe haven within the digital world.
So it's risk-off behavior inside a world that is, ironically, defined by risk-taking.
You've got it.
So as we look forward to next week, we have to address the conflicting economic data that came out today, which is just muddying the waters even more for the Fed.
Oh, the labor market is absolutely shouting contradictory signals at us right now. It's a mess.
On one hand, you have jobless claims falling to 191,000. That's the lowest level since September 2022. That suggests employers are still holding on to staff aggressively, right? The labor market is tight.
It suggests that. But then it clashes directly with two other very recent reports. Wednesday's ADP report showed private payrolls were down 32,000 in November. That's the worst reading since March of 2023.
And then there was Thursday's Challenger report,
which showed 71,000 job cuts, the worst November since 2022.
So you have this dramatic divergence between the timely claims data and the survey data from ADP and Challenger. It just creates immense uncertainty about the labor market's true path.
Is the engine robust, or is it rolling over? I mean, the Fed has to make a huge policy decision with fundamentally contradictory inputs on the employment picture.
At least consumers seem to feel a little bit better about inflation.
That's true.
We did see the University of Michigan's December Sentiment Index rise to 53.3, which beat expectations. And maybe more importantly, year-ahead inflation expectations drop from 4.5% down to 4.1%.
And that's a positive data point for the consumption outlook for sure, but the market pretty much ignored it and focused on the immediate catalyst, the December 9th and 10th FOMC meeting.
Right. We know the 25 basis point cut is largely priced in at that 87% probability, so the decision itself is almost secondary.
It's almost a foregone conclusion.
So if the cut is priced in, what is the market's primary focus going to be when that meeting wraps up?
It is entirely about future guidance. We're focused on the updated dot plot for 2026 rate expectations and, critically, Chair Powell's press conference and his guidance. The market is completely fixated on the slope of the future easing path, not just this first little step.
And based on the analytical framework we have, that means the outcome is really a binary choice between two main scenarios.
Correct. Scenario 1, which has about a 35% probability, is the Goldilocks cut. The Fed cuts by 25 basis points, delivers a balanced dot plot showing maybe 2 or 3 cuts in 2026, which would meet the current market consensus.
And if that happens?
If that happens, the S&P 500 tests its all-time high of 6,920.34 almost immediately.
And scenario 2. That one focuses more on the bond market's caution we saw today, the hawkish cut.
That's the 35% probability scenario. In that world, the Fed cuts, but the updated dot plot signals fewer 2026 reductions than expected, maybe only one or maybe none. Powell would emphasize inflation vigilance and all that conflicting labor data.
And in that case, the market would pull back.
In that case, we'd expect the S&P 500 to pull back pretty sharply, probably toward the 6,750 level, which is right near its 50-day moving average. The outcome rests entirely on those future projections.
I think that covers the key action of the day. A quiet consolidation in large caps that was masking some really intense cross-currents in small caps, the bond market, and the completely unpredictable commodity complex.
It was a day of positioning, full of conflicting signals that demand some very careful interpretation before the inevitable volatility next week.
It certainly was.
And that's the daily consolidation for today. As always, remember that the observations we provide are for informational and educational purposes only. They should never be construed as financial or investment advice.
Absolutely. You always need to conduct your own research before making any decisions. But if you found this discussion helpful, we're here every trading day after the close to help you process the most important takeaways from this session. So hit that subscribe button so you don't miss it.
We'll talk to you next time.